Hello, everybody. Welcome. We're so glad to see you here with us today for our year-end gifting strategies webinar. I'm Betsy with Elevate Wealth Advisory. And if you're new to us, we are a wealth advising firm based in Athens, Georgia. We were started in 1982 by our founder, Chuck Vickery, as Vickery Financial Services. And since that time, we've transitioned to a team of 12 people, and we are under the leadership of Deanne Rosso, our president and CEO. Today, we are so happy to have one of our favorite presenters with us, Rob Fazekas. Rob joined our firm almost a decade ago, and we're super glad to have him with us. He's our Director of Investment Policy here. Hey, Rob, how are you doing?
Good. How are you?
Good. Thanks so much for joining us today.
Of course.
I'll let you go ahead and take it away.
All right. Thanks, Betsy. Let me
Thanks.
share my screen and we'll get started. Okay, good. Hopefully you can all see that title screen.
Looks great.
All right. Well, good afternoon, everybody. Thank you for joining me. And as Betsy mentioned, we're going to be talking about gifting strategies, both non-charitable and charitable gifting. And before we begin, I want to issue just a quick disclaimer, and that's because we are going to be talking about some general tax strategies in this presentation. And everybody's tax situation is different, so these strategies may or may not apply to your personal situation. So we definitely encourage you to speak with a tax professional or a financial advisor who's really aware of your particular situation before implementing any of these strategies that we're going to be talking about. Okay, so as we said, we're going to talk about gifting strategies, and giving our money away to either friends or family or charities is really one of the few things that we can do with our wealth. So we've been working and saving our whole lives, many of us for many decades, and we've built up our nest eggs. And when we look at what we can do with our savings, there's only a few choices. And the first one is sort of very straightforward. We could spend it on ourselves. So I think we are pretty clear about that. Doesn't really need more explanation. We could give some of our wealth to our friends or our family or any other individual or our heirs after we pass. We could donate some of our wealth to charity, or we can transfer our wealth to the IRS. And I don't think there's too many people that are excited about that last one. So we're going to try to minimize that, and we're going to spend the presentation today talking about the second and the third item on this list, different ways to give our money away, and hopefully in the most advantageous and tax efficient way. So we'll start with non-charitable gifting. So this would be a gift to an individual that is not an IRS recognized charitable organization. So this could be individuals that are friends, family members, any other individual that's not considered a charity. So the first thing to know about gifts made in this vein that are not charitable are that these are not going to be tax deductible to us. We cannot deduct gifts that we make to individuals if it's not a charitable gift. And one of the first questions people want to know is if I decide to give some money away, maybe to my children, is there some limit that I need to be aware of, or do I need to worry about paying gift taxes on a gift that I make? So the first thing to know is that this year there is an annual gift tax exclusion amount that is $18,000, and that is per person per year. So that means if you're a married couple, that means each of you gets that $18,000 exclusion amount this year. And what that means is that you, as a person, can give up to $18,000 away to any number of other individuals. You could even stand on a street corner and hand out $18,000 to every person that walks by. and you would never have to worry about filing a gift tax return or paying gift taxes, right? If you kept it under that $18,000 limit. And so that means that a married couple could give $36,000 to each of their children and still remain under that limit and not have to worry about paperwork or extra forms on their tax return. The other thing to know is that a gift is not considered taxable income to the recipient. So the person that receives the gift is not going to have to worry about paying any taxes on that gift, at least not immediately. Now, there's one caveat to be aware of, which is if you give the gift of an appreciated asset, so this could be maybe a share of stock that's gone up in value, could be a share of mutual fund that has gone up in value, even real estate property, anything that's gone up in value that has embedded unrealized capital gains. If you transfer that as a gift to another person, the cost basis of that asset will transfer over as well. So what that means is the person receiving the gift, again, not going to have to pay taxes on it right away. It's not income. But if they do decide to sell that asset later, they will be responsible for any unrealized gains that were part of that gift when the gift was made. So just something to be aware of. Now, you can go ahead and give more than $18,000 to a certain person or a single person this year. Again, and really, you're almost certainly are not going to actually have to pay any taxes on that gift. So the taxes are just not going to be a problem. But the IRS does ask that if you give a large gift over that $18,000 exclusion amount, you will need to file an extra form with your tax return this year called Form 709. And that's kind of the famous gift tax return. And really, that form is just there as an accounting form to keep track of these larger gifts. The IRS just wants to know how much you've passed on to other people during life because it is going to impact your estate tax exclusion amount down the road. So let's give an example where let's say you want to give $100,000 away to somebody. So that's going to be over the $18,000 exclusion amount. And so you'll report that on that form. And now that $100,000 gift is going to reduce your lifetime gift and estate tax exclusion amount. Now, the amount is very large. This year, that amount is $13.6 million per person. So what that would mean is if you, again, sticking with our example, if you give $100,000 to somebody, then instead of 13.6 million, now you have $13.5 million left on your exclusion amount. So you can see this is just not really a problem for most people unless you're talking about very, very large amounts of wealth. But that's how that works for non-charitable gifting. So let's switch gears now and talk about charitable gifting. And probably the first question that tends to come up is, if I give a gift to charity this year, will I get a tax benefit for making that gift? Will I be able to deduct that gift to charity on my tax return? And the truth is, it's a little harder these days for most people to deduct charitable gifts. And that's because there was a major change in the tax law that was passed back in 2017, the Tax Cuts and Jobs Act. And one of the things that new law did was it dramatically increased the amount of the standard deduction. So again, when you are filing your taxes every year, you get to choose whether you're going to just claim the standard deduction amount or if you're going to itemize deductions. Now, if you want to be able to deduct charity on your tax return, you have to itemize your deductions. And so the only reason you would do that is if your itemized deductions were greater than the standard deduction, because if not, it's just better for you to take the standard deduction. And that's what most people do, because you can see on the next line that standard deduction amount is much larger than it was back in 2017. So now we're up to $14,000, 14,600 for an individual, or 29,200 for a married couple, and it's even larger if you're over age 65. So the standard deduction amount's very, very high, and so this just means that fewer and fewer people itemize deductions because the standard deduction is going to be better for them. But if you want to try to answer that question, if you think, well, there's still maybe a chance that my deductions or my charitable gifts are going to be big enough to get over that hurdle. So you need to, in that case, you would just need to look at two things. The first is, what is the total amount of your other itemizable deductions? And the big ones are medical costs. You can deduct medical costs if they are over 7.5% of your adjusted gross income. So larger medical costs, you can begin to deduct those. Mortgage interest is another main category. And then state and local taxes. So those are kind of the big ones that fit into your itemizable deductions without charity. So we'll get to charity in a second. So also note that the state and local tax amount, so this would be your state taxes plus your property taxes, there's a cap on that amount of $10,000. So even if it's larger than that, you're capped at $10,000. So you add up your other deductions, and then you ask, how much are you going to donate to charity this year? And then the combination of 1 and 2 needs to exceed the standard deduction amount. And only the amount that's over the standard deduction amount would really be deductible to you, at least as an additional benefit to you on your tax return. So let's give an example of how this might work. So if you want to itemize your deductions and you'd like to claim charity as an itemizable deduction, let's look at this example to see just how much you would have to give this year to charity in order to be able to do that. So we'll start with a married couple. They've got a mortgage on their home, and they pay $8,000 a year in mortgage interest. So they can itemize that as a deduction. Their state and local property tax amount is going to be capped at the $10,000 because of the law. And their standard deduction, because they're a married couple, is $29,200 this year. So that's the 2024 deduction. So you can ask then, how much do I need to donate to charity to be able to possibly deduct any portion of that charitable gift? And the answer is, it's a pretty big number. So you take the standard deduction amount, you subtract your other potential deductions, and you can see that comes out to $11,200. So what that means is any gift to charity that is less than $11,200, you're not going to claim those as deductions, right? You're just going to claim the standard deduction because that's going to be advantageous to you. So that kind of shows you the bogey that you're going for if you want to be able to deduct charity this year in that example. So let's look at some strategies that we can use. Let's just say you have determined that you'll be able to deduct some charitable gifts this year. What are some ways that maybe we can kind of turbocharge the benefits to us of our charitable gifts? Of course, the easiest way to give a gift to charity is to just give cash, right? That's very easy. It's very easy for the charity to use. They're happy to accept cash. And there's a limit of 60% of your adjusted gross income that you can give in any one year as a deduction limit. You can give more than that, but that's the limit on how much you could deduct this year off your taxes if you gave a large gift of cash to a charity, 60%. Now, instead of cash, you might want to consider donating appreciated securities. And we talked about that a little bit before with the non-charitable gifts. You know, these would be gifts of stock that's gone up in value, or mutual fund or something like that, an investment that's gone up. Because if you give a gift of an appreciated security, you will never have to pay the capital gains tax on that gift. The charity will be able to accept that gift and sell that gift as long as it's liquid and you can sell it. That's what they'll do. And they don't have to pay capital gains tax either because they're a charitable organization. So no one will have to pay the capital gains tax. So that's kind of nice. You could avoid that tax altogether. The limit is a little bit lower on a gift of appreciated securities. It's 30% of your adjusted gross income. So that's something else to be aware of. And another strategy to consider is, again, kind of going back to that example where you can see kind of how difficult it is these days to be able to deduct charitable gifts. If you want to consider maybe bundling or bunching more than 1 year's worth of gifts together in a single year, you may be able to exceed the standard deduction that way. If you give, say, maybe $10,000 a year, kind of on average, and you're never going to, and it tends not to exceed the standard deduction amount, maybe you give 5 years worth of gifts in a single year, and then nothing for the next 4 years. So you're still given the same amount, you're just kind of changing the timing of your gifts. You may be able to save taxes that way because that 1 year you're going to be well over the standard deduction. You can itemize in that 1 year and then just claim the standard deduction for the other 4. So donor advised funds, I'm going to talk about what that is in a lot more detail coming up in just a couple minutes, but it can make sense to combine that bunching strategy with a donor advised fund. And I will, like I said, I'll talk a lot more about that because again, if you give to a donor advised fund, you also get the full deduction for the market value of your gift. And then you can place it into that fund. It's still considered a charitable gift. So you might want to combine those two. And then another strategy, which I will also talk about in a lot more detail, is a qualified charitable distribution. So that's a gift from a traditional IRA. There's several eligibility requirements to be aware of. It needs to come directly from an IRA. It needs to go directly to a charity, so not a donor advised fund in that case. You have to be at least age 70 and a half to take advantage of that QCD strategy. And you are limited to $100,000 per year on that strategy. But again, I'll talk much more about that coming up. So going back to the appreciated assets, again, you get to, if you give that as a gift, you receive credit for the full market value of the asset in the year that you give it, and you avoid paying taxes on that appreciation. The charity can sell the asset. They won't have to pay taxes. And then if you give a gift of an appreciated security instead of cash, you could take the cash that you were going to donate and replace that asset instead. So you could just repurchase the same, shares of stock potentially, and then you'll have a higher cost basis because you're buying that today. So you end up kind of in the same place, but now you have a stepped up basis. So that means capital gains will be lower in the future. So that's a win-win for you and the charity. Okay, let's get into donor advised funds, which we talked about very briefly a couple of minutes ago. So just to give a lot more context and detail on DAFs, they're kind of like, you can kind of think about them as like a little a private foundation or a charitable investment account that you use to send money to the charities that you care about. And it's kind of neat because it's going to be a lot cheaper than opening up your own private foundation. It's like a mini foundation. But you still get some of the advantages. One is you get to name your own fund, pretty much anything you want. You can make contributions to that fund on your own schedule. And so when you contribute to a donor advised fund after you've opened it, you basically add funds to it by making an irrevocable gift to the donor advised fund, which is treated just like a gift to charity. But you're sort of making it to a fund, that you control because it's in your name. And you're pretty flexible on what you can contribute. Again, anything that's liquid, anything that can be sold. So you could contribute cash or stocks or shares of funds, bonds, really any appreciated asset that could be sold by the custodian. And then once the funds are inside your donor advised fund, they can be invested like any other investment account. So they can grow in value over time, just like a retirement account or an investment account. So your charitable dollars can grow over time. So that's nice. And then when it's time to give money to the charitable organizations that you care about, you do what's called a grant. So you issue a grant from your fund to the charity of your choice. And you can do this completely on your own schedule, based on your own recommendations. So, if you give if you make a large contribution to your own fund, you don't have to give that all away that year. You can kind of seed that out over many years if you want, and still remain on your own time frame. It's a permanently endowed legacy, so it means the fund can actually survive you and be managed by your children or your grandchildren, future generations. So it lasts a long time, and there's no requirement. Some donor advised fund custodians or administrators would request that maybe you target a 5% annual gift amount from your fund, but it's not a requirement. It's more of just a suggestion. It's kind of the target. But again, that's up to you, how much you want to give. Some years you don't have to make any grants at all. So the gift to your own donor advised fund is deductible in the year that you make that contribution. The growth inside the fund, if you invest those assets, is tax-free growth. And if you remember the strategy we talked about before, where you bundle or bunch of multiple years worth of donations into a single year, you can combine that with this donor advised fund strategy, and maybe you make a large gift to your own fund in one year, and you get to deduct that gift because it's so large. You're going to get over that standard deduction hurdle, get some tax benefit, and then you can still just issue grants from your fund on your own time frame. So as far as the charities are concerned, it's the same to them. They're getting the exact same amount that they would on the same time frame. It's just going to come from your fund instead of directly from your checking account. And you can, of course, turbocharge this strategy by giving appreciated assets instead of just cash to your fund. So here's a quick schematic showing kind of how this works. If you start on the left, the donor, that'd be you. You can give cash or other assets to your own donor advised fund. The fund is then invested and can grow over time. And then you get the tax break, which is the bottom line there that goes back to you. And then on the right side, you issue grants from your fund to the charity of your choice. So that's just kind of a graphic that shows how this all works. Okay, I'm going to give a couple of examples now of how you can get a tax benefit from making gifts either to a donor advised fund or to charity, using this bundling strategy. And I'm going to show it two different ways. The first example is for people that normally just take the standard deduction because their itemizable deductions aren't large enough. And so they claim the standard deduction every year. And then later, I'm going to show an example of someone who actually does itemize their deductions in a typical year, but how this bundling strategy can still even help them. But let's start with an example of we'll do a married couple who normally takes the standard deduction, and let's say that they tend to give $10,000 a year on average away to charity. But that amount is never quite enough to itemize their deduction. So they always claim the standard deduction. So let's see what that looks like on their on their tax return. So if they kind of stick to that schedule, if you look at the first column there that says no donor advised fund, you just take the standard deduction. So each year, again, they're giving $10,000 to charity, but their total itemized deductions are less than the standard. So they're going to just claim the standard. That's what that shows there. Back in 2022, the standard deduction was $25,900. It actually goes up with inflation. So this example is a little bit flawed because the standard deduction has climbed each year because it's adjusted for inflation. But let's just use this example anyway, as if the standard deduction were constant. But over 5 years, you would have been able to deduct $129,500 off of your tax return just by claiming the standard deduction, and again, giving away $10,000 to charity. Now, if you move your attention to the right side of the frame, you can see the difference if you use this bundling strategy, and instead of giving $5,000 or $10,000 a year to charity over 5 years, you do it all in a single year. So in 1 year, you give $50,000 away and place it in your donor advised fund. So that year, you'll definitely get to itemize your deductions because you'll be well over the standard deduction. Then in the next 4 years, you just claim the standard deduction because you're not going to give anything to charity. You've made your charitable donations for 5 years. And so nothing to charity for the next 4. But at the end, you can see that you've been able to deduct a lot more off your tax return. Now it's $163,600. That's a difference of $34,000. And if you were, say, in the 30% tax bracket, which would be 24% federal plus maybe 6% state, so a combined 30% bracket, that's about $10,000 to you, right? You take 34,000 times 0.3. By doing the strategy, you can save about $10,000 in total taxes. So you can see that can be pretty powerful. Now let's take another example where you do itemize your deductions, but you tend to be just a little bit over that standard deduction amount because in this case, we'll look at 3 years worth of donations. And again, a married couple that gives $20,000 a year to charity. So that $20,000 a year does get them over the standard deduction amount. So they will itemize each year. And we can see if we can save some taxes with this strategy, even for a couple that does tend to itemize. So let's see what that looks like. So again, we'll look at the first column there where their total itemized deductions are $30,000, which is about $4,100 over the standard. So they're going to itemize because it's more, and they'll get a little tax benefit for that. And so over 3 years, they've been able to deduct $90,000 by itemizing all of their other deductions. Now, if they did this bundling strategy, and instead of $20,000 a year to charity, they took $60,000 and in a single year and placed that in their donor advised fund. Well, now that first year, their itemized deductions are going to be $70,000. And so again, they'll be way over the standard amount, and they'll get to deduct more in that year. And then the next 2 years, because now they're not going to give anything to charity for the subsequent 2 years, they're just going to claim the standard deduction for those 2 years. But you can see you still get a benefit because now your total deduction is still higher by almost $32,000. And so you'll be able to save more than $9,000 if you're, again, in the 30% combined bracket. So even for somebody who itemizes on a regular basis, you can still do this bundling strategy and still save a decent amount on taxes if you're able to do that. So now we're going to start to talk about that last strategy, which was qualified charitable distributions. Before we get into that, I just want to mention that there was another change to the law that affects RMDs, which are required minimum distributions that we need to take from our IRAs and other tax deferred accounts at certain ages. So there have actually been two Secure Acts at this point. The first one was in 2019, Secure Act 1, and that raised the age at which we need to take required minimum distributions from 70 and a half to 72. But then there was another law that Congress passed at the end of 2022, which is the Secure Act 2.0, and that changed the age again and delayed it another year for people born before 1960. So it raised the age from 72 to 73. And if you're born after or on January 1st, 1960, now the age at which you need to take RMDs from your retirement accounts is now 75. So that recent change has provided us an extra 12 to 36 months to let retirement funds grow before we have to take withdrawals from our tax account. So the reason I bring that up is because it kind of explains why the age that we can use this QCD strategy is kind of stuck at 70 and a half when it really kind of shouldn't be. It's almost like it might be an oversight on their part when they wrote those two laws, because it's kind of a strange quirk that both of those Secure Acts, even though they changed the RMD age, they did not change the age for when you are allowed to take a qualified charitable distribution from your IRA. That has been left at 70 and a half. So that means this strategy is available to you if you are 70 and a half or older. So once you reach that age, you and or your spouse could contribute up to $100,000 each year to a 501c3 recognized charity directly from your IRA. And the reason you'd want to think about doing this is that if you do this properly and you meet all the qualifications, a QCD is not considered taxable income. In any other case, when you take money out of a tax deferred retirement account, you're going to pay taxes on that income at ordinary rates. But this is one way to get money out of an IRA without having to pay taxes on that distribution. Also, once you do reach the age where RMDs begin, these charitable contributions, the QCDs, can also count toward your required minimum distributions. So for example, if you are forced to take $10,000 out of your IRA because you've reached age 73 and your RMD is 10,000, if you take that money out and just kind of put it in your checking account, you're going to pay taxes on that. It's taxable income. But instead of doing that, you could consider a QCD, take that $10,000, send it directly to a charity, and now you've satisfied your RMD for the year, but you have not added to your taxable income. So we'll show a couple of examples that hopefully illustrate this even better. So let's look at two examples of someone who is subject to an RMD for the year, and they're deciding whether or not to use a qualified charitable distribution. And so you've got two options. We'll start with option A, which is let's say you have a $10,000 required minimum distribution, as I mentioned before, and you need to take that amount out by the end of the year. And so the year begins and you withdraw $10,000 from your IRA account. You've now satisfied your RMD for the year. And then maybe at the end of the year, you're deciding which charities to support, and you make a $10,000 gift to your favorite charity or charities by the end of the year. And the charity receives that $10,000, but the $10,000 that you took out is going to be reported as taxable income, going back to your RMD. And if you're in the 24% federal bracket, you'll pay tax of $2,400 on the $10,000. So really the total cost to you of making that charitable contribution is going to be $12,400 because you're going to send the 10,000 to charity and you're going to pay 2,400 in taxes on the distribution. So let's look at what this looks like if you were to do a QCD instead. So the difference here is instead of taking $10,000 out of your IRA and putting it in your checking account, you're going to transfer $10,000 directly to the charity from the IRA. So you're never going to see the check. It's never going to touch your hands. It's going to go directly to the charity. But because you've taken $10,000 out of your IRA, you have still satisfied your RMD for the year, right? That's covered. You've taken care of the RMD, but the difference is no taxable income is going to be reported because you've used this QCD. So the tax bill on this distribution is going to be zero. Nothing is added to your taxable income for the year. And so the total cost of this charitable contribution to you is just going to be the $10,000, and that's a savings of $2,400 compared to option A. So some other advantages with the QCD, you get to exclude taxes on the gift, and you can still just claim the standard deduction because now you've made your charity, but you don't have to worry about trying to itemize deductions on your charitable gifts. You'll still get that larger standard deduction. And by lowering your taxable income, you might be able to reduce the cost of your Medicare premiums because Medicare premiums are based on your modified adjusted gross income. So by doing a QCD, controlling your income and keeping it lower, you might be able to save some Medicare premiums when they calculate what your premium should be, which is again based on your income. And your taxes that you pay on your Social Security benefits are also related to your other income, the amount. So you might be able to even save taxes on Social Security as well by pursuing this QCD strategy. So there's a lot of potential kind of cascading benefits that may come along with this if you do that. So just to summarize what we've talked about today, you've got lots of different ways that you can make gifts to charity. A lot of people just give cash to charity because it's quick and easy, and the charities can use it easily, and they appreciate that. But there may be some other ways to make gifts that might be even better to you from a tax point of view. You can give appreciated assets and avoid paying capital gains tax. You can use a donor advised fund, which allows you to make a big gift, to deduct that gift that you make to your fund, and then control the timing of those grants that you issue from your fund on your own schedule. If you're eligible, you might be able to use a QCD, qualified charitable distribution, from a traditional IRA account to also limit the amount of taxable income that you have and shield that distribution from taxes. And you may instead decide to bequest taxable assets to charity, assets that are in a tax-deferred account that your heirs would ultimately have to pay taxes on anyway. You can kind of choose what makes sense based on their tax status, what to leave to charity and what to leave to your family, because some assets are better to inherit as a family member because they'll receive a step up in basis and avoid having to pay taxes on those kinds of assets. So some things to think about, and hopefully this will help you kind of decide which one of these strategies is best for you. So I will stop my screen sharing and end it there and see if there are any questions.
Thank you so much, Rob. That was amazing as always. We do have one question, and then anyone who's watching, if you have a question, feel free to drop it in the Q&A or the chat box, and I will let Rob know. But one question is, obviously, with gifting at the end of the year to family members, you can do that anytime before the end of the year. How long does it take to set up a QCD or a donor advised fund? And
Uh,
how soon should we get started on that?
yeah, the QCD shouldn't take too long as if that assumes that you have a traditional IRA already, and you know what charities that you'd like to send that to. It's usually just a 1 or 2 page form that you fill out. Sort of, just you decide where it goes, and you need some transfer instructions to make sure it goes in the right place. But I would say within a week or 10 days, they can probably get that done. That shouldn't take too long. You might not want to wait till the very end of the year because it tends to get busy and everybody's doing the same thing. But that's not too complicated. And opening a donor advised fund, probably about the same time frame. Maybe I'd give it a week or two. You need to, there'll be some paperwork it's like opening an investment account, and then so you'll fill out some paperwork, and then it'll take a few days to transfer assets over to it, but probably within 2 weeks you can get that done.
Okay, very good. And I know at Elevate we do have companies we work with to create those donor advised funds. So
We
if
do.
you are interested in something like that, feel free to reach out to marketing@elevate-wealth.com and we'll get you to the right person. I don't see any other additional questions, so I guess you were very thorough as always.
Of
Thank you so much, everyone, for joining us. And thank you, Rob, again, for all your time today. We always love hearing you present.
course, thank you.
All right. Take care. Have a happy
Thanks.
Thanksgiving. Bye-bye.
Bye.